Let's start with a crazy question. What if you had a superpower? What if you could perfectly sidestep the 5 absolute worst days in the stock market every single year? It sounds like a complete fantasy, right? But just think for a second about what that would actually mean for your money.
All right, let's put some real numbers to this. If you put a single dollar in the market and just left it alone for a few decades, it would have grown to about $11.71. Pretty good. But if you'd use that superpower to miss those 5 worst days each year, that same dollar would have exploded into almost $1,000. The difference is just mind-blowing. And it perfectly captures that seductive dream of market timing, the idea that we can be in for all the good times and out for all the bad. But is it a dream or is it a trap?
That whole idea of timing the market perfectly is really at the heart of what we're digging into today. See, the desire to get returns like that is what separates a passive investor from an active one. So today, we're going beyond the simple buy and hold strategy to look at the playbook for the active, engaged, or as we'll call them, the enterprising investor.
Welcome, everyone. This video on investment basics is brought to you by Mr. Majid Butt, whose unique background as an accountant, a software programmer, and a dedicated investment researcher gives us the framework for our deep dive today. So here's our game plan. First, we're going to figure out what it really means to be an enterprising investor. Then, we'll expose some of the market's most popular and most dangerous traps. After that, we'll break down 3 specific, actionable strategies for anyone willing to roll up their sleeves. And finally, we'll help you figure out what kind of investor you truly want to be.
Okay, let's jump right in. Section 1. A quest for superior returns, and defining this thing we call the enterprising investor.
The definition here is simple, but it's really profound. An enterprising investor isn't just someone who takes on more risk. It's someone who is willing to put in the time, the actual effort, the mental heavy lifting to get results that are better than average. It's all about treating investing less like a passive hobby and more like an active business.
So what does this effort actually look like in practice? Well, it usually falls into one of these 4 buckets. Now, the first 2, market timing and chasing popular growth stocks, that's what most people think of. They're also, as we're about to see, the most treacherous paths. The last 2, finding real bargains and getting into special situations, that's where the disciplined work is and where the real opportunities can hide. And that leads us perfectly into our next section, the market's popular traps. We're going to explore why these common strategies so often end in disappointment.
Let's circle back to that tempting idea of market timing. It's all based on having a feel for the market, some kind of special talent for predicting what's going to happen next. It's an absolute emotional roller coaster. Now, formula investing is the complete opposite. It's about creating a system, a disciplined plan, like always keeping your portfolio 50% in stocks and 50% in bonds, and just sticking to it no matter what. It replaces guesswork with principles, and it takes emotion out of the equation.
And this quote just hits the nail on the head, doesn't it? Hindsight is always 20/20. We can all look at a chart from last year and point to the exact day we should have bought and the exact day we should have sold. But in the real world, when things are actually happening, that clarity is gone. Foresight is blind. Trying to time the market is basically like driving a car at night by looking only in your rearview mirror. It's just not going to end well. All right, now for trap number 2. This one feels so logical, so right, but it is filled with hidden dangers, and that's chasing the popular growth stocks. You know the ones. They're the darlings of the market, the companies everyone is buzzing about.
Just take a look at this story from the late 90s. We've got 3 titans here: GE, Home Depot, and Sun Microsystems. Their returns were just off the charts. We're talking 45, 52, even 120% a year on average. But look closer at what was happening with their price-to-earnings ratios on the bottom. GE's PE more than doubled, Home Depot's more than doubled, and Sun's nearly quintupled.
This brings us to a crucial point. Seriously, this might be one of the most important lessons in all of investing. A fantastic, innovative, world-changing company can be a terrible investment if the price you pay for its stock is already priced in decades of future success. The quality of the business and the quality of the investment are 2 completely different things.
And here is the inevitable aftermath. The party always ends. From the end of '99 to the end of 2002, these exact same stocks just collapsed. GE got cut in half, Home Depot dropped by 2/3, and Sun Microsystems was practically wiped out, falling over 90%. The businesses were still good companies, but the stock prices had been inflated by pure hype to levels that just weren't sustainable. Their PE ratios came crashing back down to reality, and the investors who bought at the top, they paid a brutal, brutal price. So it really all boils down to two fundamental problems. First, by the time a company is widely known as a great growth stock, all of its amazing future prospects are usually already baked into a really high price. There's no bargain left to be had. And second, and this is a bit more humbling, is that our predictions about the future are often just plain wrong. No company, no matter how amazing, can grow at an explosive rate forever. The bigger they get, the harder it is to maintain that pace.
So, if chasing popular stocks is a trap, where should an enterprising investor actually look? Well, that brings us to our first real, actionable strategy. Focusing on unpopular giants, finding value where other people just aren't looking.
The whole idea here is to take advantage of a basic quirk in market psychology. The market is emotional. It falls head over heels in love with glamorous, exciting stories and pushes those stocks to the moon. But it also overreacts to bad news, punishing solid, established companies for temporary problems. And that creates huge opportunities for the calm, level-headed investor.
And hey, this isn't just a theory. We've got decades of data to prove it. This study looked at the stocks in the Dow Jones Industrial Average. It split them into the 10 cheapest or most unpopular stocks and the 10 most expensive or most popular ones. Just look at the results, time period after time period. The unpopular stocks consistently and dramatically beat both the average and the popular stocks. I mean, look at 1958 to 1962. They returned over 10% a year, while the popular stocks actually lost money.
So the takeaway here is crystal clear. The market often gets it wrong. It pays way too much for glamour, and it pays way too little for solid but temporarily troubled large companies. For the patient investor, this creates a systematic advantage. You're essentially buying strong businesses that have the resources to recover, but you're getting them at a price that reflects short-term pessimism, not their long-term value.
All right, let's move on to our second strategy. This one gets even more specific, a little more quantitative. This is for the true bargain hunter out there, the person who wants to find deeply undervalued companies. So what exactly is a bargain? It's not just a stock that's gone down in price. A real bargain is a stock where your careful, fact-based research shows that it's worth a lot more than what it's selling for. And you need what's called a margin of safety. A really good rule of thumb is that the true value should be at least 50% higher than the current market price. That gives you a nice cushion just in case your analysis isn't absolutely perfect.
Okay, so how do we actually find this hidden value? Well, there are two main ways to approach it. The first is what we call appraisal. It's forward-looking. You try to estimate what a company might earn in the future and then apply a reasonable multiplier to that. The second method is more grounded in the here and now. You ask yourself, what would a private owner pay for this entire business right now? And that usually means you focus less on future dreams and more on the hard, tangible assets the company owns today. Okay, now this is one of the most powerful bargain signals you can ever find. It's when a company's stock is trading for less than its net working capital. Just think about what that really means. Net working capital is basically the company's cash, inventory, and other stuff it can sell quickly, minus all of its debts. If the stock price is less than that number, you are buying those liquid assets for pennies on the dollar. And you're getting all the long-term stuff, the factories, the buildings, the brand name, for absolutely free.
And once again, this strategy has been proven to work over time. Check out this study of 85 of these net stocks, as they're sometimes called. A portfolio was bought at the end of 1957 for about $1,000, when the net assets were actually worth over $1,800. 2 years later, that portfolio was sold for over $1,900. That's a 75% gain, which crushed the overall market's 50% gain in the same period. It's a strategy that definitely requires patience, but the odds are heavily stacked in your favor.
Now, our third strategy is the most advanced, the most specialized. We're entering the world of special situations, which is all about making money from corporate complexity. These are sometimes called workouts or arbitrage. The key here is that your profit doesn't depend on the stock market going up or down. Instead, your profit depends on a specific corporate event happening. So, for example, if Company A announces it's buying Company B for $50 a share, but Company B's stock is only trading at $48, well, an investor can buy the stock and plan to pocket that $2 difference when the deal finally closes.
The opportunity here comes from the same place as our other strategies. It's all about market psychology. Most investors run away screaming from complexity, from uncertainty, from lawsuits. That old saying, never buy into a lawsuit, creates a bias. And that bias pushes the prices of these complicated situations down to levels that are often way below what they're probably worth, creating opportunities for people who can actually do the homework and analyze the situation correctly. Now, I have to give you a crucial word of warning here. This is not a game for amateurs. Seriously.
To profit from special situations, you need deep legal and financial knowledge. It is a highly technical area of investing. And while it can be profitable, it's really only a good fit for a tiny, tiny fraction of even the most dedicated investors.
And all of this brings us to our final, and maybe our most important section. After looking at what it takes to be active, it's time to choose your investor identity. Are you a passive defender, or are you built to be an active, enterprising investor? Let's just be really clear about the two different paths here. The defensive investor, the passive one, is all about safety and simplicity. The goal is a satisfactory result, not a spectacular one, with as little stress and effort as possible. The enterprising investor is playing a totally different game. They are willing to put in the time and the energy to operate like a business, using their knowledge and their judgment to shoot for superior returns. And look, there's no right or wrong answer here, only what's right for you.
But here's the thing you absolutely have to avoid: getting stuck in the middle. This quote is a huge warning. You can't be half enterprising. You can't just dabble in these active strategies without the full commitment, the full knowledge, and the right temperament. That is the path that most often leads to terrible results, where you end up with the higher risks of active investing but the lower returns of a passive approach.
So the most important thing is to make a deliberate choice. After seeing what real enterprising investing looks like, the disciplined search for unpopular giants and deep bargains, not just recklessly chasing fads. Which path are you going to take? Will you embrace the elegant simplicity of the defensive approach, or are you ready to commit to the hard work of being an enterprising investor?
Whichever path you choose, the journey of learning never ends. You can subscribe to my membership to access exclusive videos on analysis of financial statements of public limited companies listed on stock exchanges around the world, which are not available to others. Thank you for watching.